Interest rates, if you go on social media, there are so many different opinions in regards to whether the rates are extremely high right now or are they what they should be compared to many years ago. And I've had a lot of conversations with folks on Twitter, Facebook, and lots of different other social media platforms. And I mean, when you think about it, rates were commonly 8 to 10%. That's where you could take your money and put it into a GIC back in the good old days and get that kind of income from it. The average car loan was 12%, and the average mortgage was at least 6 to 10%. And now we have a lot of people from a different generation that really haven't seen interest rates much higher than zero in a very long time. So let's look at some of the negatives and the positives and how this is affecting retired folks currently in the environment we're in. So the positives in a higher interest rate environment is one of the obvious ones is the fact that a retired person can get a 5 to 6% GIC for a 1 year term and derive a pretty good income from their investment risk free. One of the other things that's happening right now is annuities, which were out of favor for the longest time, are starting to come back in favor because, same thing again, when interest rates are higher, the monthly payment that you can receive on a life annuity or a term annuity are a lot higher when interest rates are 5 and 6%. For the longest time, it just wasn't worth it to put your money into an annuity. One of the other things that is happening that's very positive is the fact that you just don't have to put your money or all of it into equities or the stock market. And that in itself creates a comfort for retired folks to be able to put their money somewhere and get a reasonable return without the risk. So now let's look at the negative side of high interest rates for some retired folks. One of the things that's happened in the last 10 years is the fact that the housing market has exploded and the price of housing has gone up considerably. Now, if you're a senior and you own your home, that's great. But unfortunately, what's happened is a lot of seniors have lent money to their kids to get them into the housing market, and they've taken on debt, whether it be refinancing their homes to provide down payments for their kids, or put that debt on a line of credit. And currently, right now, a line of credit is paying between 7 and 8%, depending on how it's set up. And a lot of seniors have opened the bank of mom and dad and provided their kids with these loans. Also, there's been a lot of real estate, secondary real estate, that's been purchased in the last few years using these lines of credit as well. And the fact that interest rates are so high, this could be a detriment for retired folks as well. One of the other negatives for retired folks in this current high rate environment is the fact that reverse mortgages have come into play in a big way. The cost of living and the fact that seniors haven't been able to save enough in their working years means that they need to derive a way to invest to get income. And most seniors, their biggest part of their wealth is in their home. So the fact that a lot of reverse mortgages have been taken out in the last couple of years in Canada can be a very negative thing for a lot of seniors, as the interest rates on these reverse mortgages are a lot higher than the going rate. You can be paying between 6 and 10% for a reverse mortgage. So a lot of equity will be getting eaten up by these reverse mortgages. As long as real estate stays at a high level and the prices keep going up, that isn't a big problem. But if we keep seeing the housing market lowering as it has, this could mean that a lot of seniors could lose all their equity in their home. And if they had planned on passing that down to future generations, that equity just might not be there. In closing, where do we see interest rates going? Well, I'm not a fortune teller, and I don't think anybody is, but from what all indications are showing, rates will be between 2.5% and 3.5% around the end of 25, beginning of 2026. And so that would mean about a mortgage of around 3%, maybe 4%, which isn't such a bad thing. We need to, in our society, we need to have rates that are kind to debtors, but at the same time, they're also kind to retired folks to be able to derive some income from their life savings in retirement without having to shoulder a whole bunch of risk. The biggest problem that we have right now as far as rates is the comparison to the housing market. And, home prices are high, and I don't really necessarily see that changing too much in the future. It's not good for future generations, but at the same time, a lot of older folks are voters, and I don't think that the government wants to see house prices crater either in that sense. So thank you for watching. I hope this information gave you a little insight into this topic. Please subscribe to my channel, hit that like button, and I look forward to my next video, and have a wonderful day.